Hi, I'm Aaron Chan, the founder and managing partner of Recurve Capital. I have with me today Dave Schaeffer, the founder, CEO, and chairman of Cogent Communications. Dave, thank you so much for joining me today.
Hey, Aaron, thanks for taking the time and having an interest in Cogent.
Yeah, great. Well, before we begin, I have to read a quick disclaimer. So I'll get that out of the way. The full disclaimer is in the notes attached to this video. But this interview expresses the views of its participants only as of the date indicated, are subject to change without update, and may not represent the views of Recurve Capital LLC. Recurve makes no representation that any past securities performance discussed should be an indication of future results. No information contained in this interview constitutes investment advice or any offer to sell or buy securities or other investment products. Again, for the full text, please refer to the notes. So, before we get started and hearing from Dave, I want to set the stage by talking about my involvement with Cogent and my evolution with the company. I think I met Dave about 10 years ago at a conference in San Francisco. And before the meeting, I was doing some research on the company, and it looked to me like a stock that was trading at a pretty significant premium to the sector, that it sold commodity services in a footprint that others operated in, and it didn't look all that attractive to me at the time. I had a negative bias going into the meeting, and through the first conversation with Dave, it was clear that Dave had taken a very different approach to the telecom market relative to everyone else that had been operating there. First of all, because there was an immediate admission that this is a dumb pipe business in the end. And every other telecom company, for the most part, maybe there are those that haven't believed this, but I think everyone believed that they had a unique pipe, the application-specific pipe added value. So Dave had a very unique view on the industry and what the endpoint of the industry and the maturity of the industry would look like. And I think it led him to create a company that was very differently organized and capitalized relative to the competition out there. We'll get into that in much more detail. This is a unique time to be talking to Dave because for the first time in almost 2 decades, Cogent is on the cusp of making an acquisition, which seems to be very interesting and offers a lot of new opportunities for the company over the ensuing years. So, Dave, I'd like to, obviously we want to talk a lot about Cogent, but I'd love to hear some of the origin story about Dave Schaeffer. You have a pretty unique early life and upbringing, and I'd love to, hear more about that and your early life, your interests, your education, because it's pretty unique.
Well, listen, I'm a lucky guy. I've never had a real job in my life. And,
I don't know if that's true.
I've actually been able to found 7 companies and I think do things that I find interesting. I grew up in a fairly modest background. I was lucky enough, if you think of it this way, to go to school, college when I was pretty young, and had a variety of interests. And I was 12 years old going to college with people a lot older than me. I took a lot of courses in a lot of different areas, and was finishing up my PhD defense of my dissertation. I was about 17, and my dad asked me to join him in turning around a family business. And while it was probably the last thing I wanted to do, it's what I did. And within a year, that business looked very different. My 2 brothers joined me, and I was pretty quickly addicted to the cash flow and lifestyle that afforded me. And, from that business, had a number of additional opportunities that I expanded out into.
I want to go back because there's a lot there. So you're 17, you've written your dissertation, your PhD dissertation. What was that in? Was that I think I read that you had economics degrees, physics degrees. Was it in economics or physics?
So my undergrad was in physics, and
Okay.
then I actually switched to economics. I found many areas interesting, and there were two challenges. The first challenge was a very practical one, which was the number of courses I could take in one part of the campus and be able to walk from one building to another in enough time. Second thing was that hard sciences typically required a lot of lab work, which I found to be relatively inefficient.
Mm.
And, when I went to school, I tried to be efficient. I was too young to drive, obviously, and I would get up at about 5 in the morning, get on a public transit bus, not a school bus, at around 6 to be at school by 8 to take my first class. And I would typically leave in the evening around 6 in the evening. And I literally took classes all day long. So finding classes that were adjacent to one another on a large campus was interesting. So I took a lot of math, physics, chemistry courses, but a lot of those had a lot of lab requirements, which tended to be fairly time consuming without a lot of learning. So I started taking history and economics courses, and I was actually almost expelled from the University of Maryland. So I was accepted in a number of schools, but chose to go there. I didn't think I was old enough to live by myself and wanted to live at home. So I went to the state school, and they had a great deal. You could take as many courses as you wanted as an undergraduate for a flat fee of $349 a semester,
Hmm.
which was a real bargain. Maybe not quite as good as California, which actually was free at the time for state residents, but $349 was a pretty good deal. And there was a second loophole, which is you could take graduate level courses, which were usually charged by the credit hour, if you met the prerequisites and could do the coursework. So effectively, I stayed as an undergraduate, but was taking all graduate courses. And I actually got a letter from the president of the university. What is this for? It was a real letter to me. And I went in and met with him, and he said, you're violating all of our rules, taking all courses in a lot of different areas, and you must declare a major, get a degree, and become a grad student, and therefore pay us the per hour rate as opposed to the flat rate, or we're going to be forced to ask you to leave. And I said, that's not a great choice, but I get it. So I ended up getting my physics degree, but I had already taken most of the physics grad courses. So
Sure.
I ended up going into the economics department and paying by the hour. And since I'd already had most of the credits, I didn't have to pay for very long before I could get my dissertation submitted.
It sounds like you consumed all the credit hours available, undergrad and grad, in your 5 years.
Pretty much. At the school I was at, the normal load for a full-time student was 16 credit hours, and I was typically taking 40 a semester. So
Unbelievable.
it just allowed me to learn a lot quickly.
No kidding. No kidding. So I want to hear more about this decision to join your dad and help your dad. So he asked you when you're 17 years old to help him run the tax season,
Yep.
correct? What was that like, and what role did he ask you to take within the company when you joined?
Yeah, so my dad was a cab driver and eventually had his own small cab company. It had 49 cars. He was running it out of a one-bay gas station that he rented, and he managed to get himself and this was in the early 70s, so it's been like 71, basically $1 million underwater net debt. And what had really changed was the demographic of the other cab drivers, and he was experiencing a lot of bad debt. And he asked myself and my two brothers, who were older than me, to come in and help fix the debt problem. And we quickly realized that the cab driver was the customer, not the rider. Two, that you needed to structure a system where you could reduce the bad debt and lower your capital intensity. So we quickly pivoted from buying new vehicles to buying surplus government vehicles, mostly police cars. Two, we moved from renting the cars to the driver to doing a lease purchase agreement. So the driver felt they had some equity ownership, even though in reality, the cars broke down so frequently, you always had to refinance them, and the balance just accreted up. They never were able to pay the vehicles off. And that allowed us to both increase net receipts and reduce bad debt. It was still high just based on the nature of the customer base. But within 3 years, we were able to turn that business around and grow it from 49 vehicles to a little over 2,000 vehicles, and making it actually the second largest cab company. Yellow in Chicago at the time was larger. And it was a market, again, being lucky is the right thing. It was a market that was deregulated, so there were no medallions, so growth was easy. Now, the downside is you weren't building any asset value in those vehicles, but you had good cash flow.
Interesting. And were you leading the company? Was your dad? Were your brothers? What role did you enter in at?
So we were all technically partners. When the business got of scale, we actually each worked in our own physical location because there wasn't enough real estate to house something of this size and what location. We took over an old car dealership, a couple of warehouses, but I was effectively functioning as the CEO, making the capital and strategic decisions, but literally working alongside of everyone. And I think, it was a true partnership in that we were all, consensual in what we did and all motivated to the same goal.
I'm sure there's a lot of relationship dynamics that happen when it's a family business and you're the youngest that's leading the charge. So I'm sure that was maybe great, maybe not so great in some circumstances, and everything in between.
Well, I think I had the respect of my brothers. Part of the way I was able to become proficient in school, my oldest brother is 11 years older than me. And when I was about 3 years old, he had me start doing his homework for him. And I was able to get him good grades and teach myself an awful lot. So, there was a good give and take between the two of us.
That's unbelievable. A 3-year-old doing a 14-year-old's homework is unbelievable. That's a great story. So from an early age, obviously you had a lot of academic learning, but you maybe didn't have as much of the practical, or maybe you did and we haven't talked about it, but in terms of operating a business, managing people, managing an organization, making investment decisions and capital allocation decisions, how did you evolve those roles and responsibilities, and how did you develop those skill sets when you went into the operating role?
So, literally, we started with nothing. And to get initial working capital, I ended up pitching a local community bank president and getting $100,000 signature loan for the newly incorporated business. And that was truly all of the working capital we had. And you had to make tough capital decisions. I remember there was a year when you either paid to heat the garage or you paid the car loans on the vehicles that had been financed. And, they were really tough decisions, but you end up realizing capital is precious. You need to be thoughtful about acquiring debt. You need to be thoughtful about putting that capital to work quickly. In negotiating, there was, 2,050 or so cab drivers, and they all had stories, and they were all very economically challenged. And, when you repossessed their cars, you were taking their livelihoods. So you had to learn to negotiate quickly with those individuals and show them why. So, it was just managing it. We had probably 300 or 400 direct employees, but then we had to support the fleet. And it was just managing, a reasonable scale business.
What was the outcome of that business? How long did you guys run it for, and how long were you involved with it?
So I was there for 17 years. When my dad got ill and decided to retire, I took that opportunity to exit. My brothers actually didn't want me to go away, wanted me to stay. And we ended up, took almost a year of negotiations to structure a deal. My middle brother took a pile of cash and really hasn't worked since. We downsized the cab business dramatically, and my oldest brother kept running that. And I had, in that intervening period, we had together started a couple of businesses, but also I had done some things on my own that my brothers were not interested in. So I had excess capital, and I literally just walked away. We set up a life estate for my parents, so they were taken care of, and I just started from scratch.
And what were some of the other things that you had been tinkering with as you were approaching the exit from that business?
Yeah, so early in the cab business, it became clear to us that we had reached a wall. DC at the time was primarily a minority city with a minority government. We were 3 white guys living in the suburbs. We controlled about 35% of the market. So what we did was, rather than continue to acquire other companies and gain scale, we indirectly controlled them 2 ways. We started an insurance underwriter. That's actually the largest single expense the livery company has, is this insurance. It's actually more than the car itself. And we founded a property and casualty company. It was actually the first one founded in DC since 1937. So it went from 37 to 1980 with no new companies being domesticated. And the last one before us was Geico. And we capitalized that business with $1.5 million, and then gained about 90% market share in covering the DC, Maryland, Virginia market for insurance. And then we really were undercapitalized to expand beyond that. So I was actually willing to raise external capital. My brothers didn't want to, so we just kind of stayed there. The second way we gained control is cab business had an interesting attribute. It tended to be land intensive to park the cars, but usually wanted to be close to central business district. So as a result, we bought the underlying real estate of all of our competitors. So we insured them and we had their underlying real estate. Well, we didn't own them. We had effective control of virtually 100% of the industry.
That's Fascinating. I have a couple follow-up questions on that, just out of curiosity. Did you operate with an underwriting profit on the P&C insurance company?
Yeah, so the P&C company actually made a very modest profit. Or loss experience ratio was generally around 86% of premiums, but the money you make in insurance is actually the investment income.
Right.
You have really two things. You have the premiums that come in early before you start paying claims, which builds up a capital base, and then it slowly grows as your business grows, allowing you to generate incremental excess capital or surplus. But then it's your investments. So we did some real estate deals through it. We did mortgage underwriting. We did some, more traditional business investing. But, we had pretty quickly built a capital pool of about $50 million back in the early 80s. That was really our base of investment capital.
I mean, it's fascinating because you take the premiums. Most P&C insurance underwriters don't, they have marginal losses on the insurance underwriting business. And they make their money on the float, right? So for you to, I suspected you might have, managed the business in such a way that you would actually turn a small profit, including all the benefits from the float. So did you effectively use the float from the insurance operations to fund the land acquisitions in that second part, to buy the land underneath your competitors' parking lots, or?
Generally not, because of the fiduciary Chinese wall. So we would typically underwrite other acquisitions, take security, but then use our global balance sheet to buy properties. And we ultimately did 47 deals together. We actually still own 5 of them, and they're really covered land plays. And again, it's good to be lucky. We did stuff where the convention center got built. We did stuff where the second convention center was built in DC. We had some properties where the baseball stadium was developed. So these were neighborhoods that very rapidly gentrified, and, the properties on an absolute basis, 10 or 20x their value.
Wow. That's unbelievable. So how did you come to the communications business? What was your first entry into it?
First entry was actually radios for cabs. So initially, our cabs were non-radio dispatch. We added radios to them as another control point. And at the time, Motorola, before it split into 2 companies, dominated the land mobile business. This was kind of pre-cellular, and they were direct distribution. As Motorola pivoted into cell industry, they then migrated to a dealer model. With that dealer model, we ended up getting a franchise for the Mid-Atlantic. And with that franchise, we were able to then use relationships in the cab industry to distribute radios nationwide. And in addition to that, there was the beginnings of SMR, trunking radio. So prior to 86, radio spectrum had no property rights. In advance of some of the early cellular systems, all of the spectrum above 490 megahertz would be granted proprietary licenses, but you had loading criteria. And because the spectrum that was in use was adjacent to the A and B band original AMPS cellular licenses, this spectrum could have real value. So what we did was, I went around the country to other cab operators, offered them the ability to get a free computer dispatch system. This was long before Uber, where it used to be you had hoot and holler circuits to get a cab. You call in and somebody like yelled all the drivers, and you all listen all the time where the car is. And eventually that migrated to in-car terminals. We would provide those in exchange for a local partner loading the system. We would strip off some of the frequencies and then have those available for sale to what became Nextel. So I ended up doing 170 channels of SMR around the country that got sold in the roll up to that and created a lot of value. I mean, my average basis for the licenses were $35. The actual computer equipment was financed, but we didn't make anything, but we didn't lose anything on that. And then the channels typically sold for a couple $100,000 a piece.
Wow. Is that similar to what the Clearwire guys did, rolling up the education and religious spectrum and creating value from that roll up?
Clearwire was a little bit different. So what Clearwire had done is took the 2500 megahertz band.
Sure.
That's really kind of not viewed as usable. It was allocated to hospitals, community colleges, and community policing efforts. They could not transfer those, so they entered into something known as an LMA, a lease management agreement. They would get rights to them, and then they petitioned the FCC to allow them to use them for mobile operations. They had to wait about 15 years, though, until there was actually equipment available that would work. And then eventually that spectrum got just collapsed in with the 18 and 1900 megahertz spectrum. The SMRs were different. They were mostly at 800 megs. There were some at 900, and they were able to be, so the rule was you needed to have 70 active users within 2 years to keep a channel. If you had 5 or more adjacent channels, you could do something known as trunking. You can blend them together into a shared pool, which made them valuable. As individuals, they were not valuable. So the typical model was to go to a market, get 7 frequencies, get an operator who could meet 500 unit loading, strip off 2 as operating for the cab business, take the 5, trunk them, and then sell them to a mobile aggregator.
I see. That makes sense. Interesting. Without going through every company you've started and operated, I wonder if there are some commonalities in them, whether it's that have brought you to those businesses. Obviously, it sounds like you've had a group of them that have been tangential to the taxi business and that were kind of came from your experience there and all the kind of offshoots from that business. But were there any other kind of commonalities that existed across your other entrepreneurial efforts, whether it's a change in regulation, some kind of loopholes that you're trying to exploit, that you saw an opportunity? How would you describe that?
Yeah, so first of all, I made a somewhat thematic view that with telecom deregulation beginning in '83, that would be a growth sector. I was not a communications professional. I did the SMR business. I actually started a paging carrier when the government unleashed another tranche of spectrum. And for the first time, they allowed consumers to own the paging device as opposed to leasing them. They were typically licensed under the RCC, Radio Common Carrier Bureau. They moved these new licenses to the Private Carrier Bureau, and customers could actually own the subscriber device. That was radical. And that business grew rapidly. I actually looked at participating in the C-band PCS auctions. I quickly realized I was outgunned, but I used a regulatory arbitrage there to build a business to aggregate excess telecommunications capacity from utilities. And then, when I started Cogent, I took kind of a bet on the internet being the only communications technology that would really matter over the long run. And usually you need to find some niche to exploit where you have an unfair competitive advantage. Generally, this has been an industry with large amounts of capital, very protected, large incumbent operators. And for an entrepreneur, there's no chance of success. I'll never forget when I was doing the IPO roadshow for my previous company. I was at 21 for the luncheon, and an investor came up to me afterwards, and I thought I was prepared to answer any question. And I didn't know how to answer this guy's questions. He asked me how many years I had worked at 9X. And the reason was I had hired the former CEO of 9X to be my CEO. I became the chairman, and I didn't want to insult my CEO, but I had a fairly low opinion of telco executives and the ability to, kind of capture value that maybe they didn't focus on.
Mm-hmm.
So, yeah, it's an interesting pathway to get here.
So let's talk about Cogent and the angle you saw at within this opportunity. You said you need to find a niche where you have an unfair competitive advantage. You're going up against, it was the late 90s, there's capital flooding the telecommunications market. What did you see back then? You took a view that's very different from everyone else at the time, I think, which was the internet will win, and applications will ride over the top of the internet, and that is what will ultimately win. And I think back then it was very controversial. Even 15 years ago it was controversial. Even 10 years ago, maybe still somewhat controversial. Today, I think it's taken as fact. But what was the niche and what was the angle that you approached the Cogent concept with?
So I had taken my previous company public. I was able to sell my shares in a block trade. And I was thinking about what I wanted to do next. And I realized that the internet would succeed. And it would succeed for three reasons. One, it would reach the most number of users. Two, it was a network that could sit on top of any other network. So you didn't need to build a network from the ground up to support it. And then third, it was a network with no application, no particular purpose. So it allowed people to develop applications that would ride on it. Bob Metcalf, the guy who invented Ethernet as a common machine-to-machine communications protocol, coined a statement. He gave a speech at Interop where people called it Metcalf's Law, where he said the value of a network is equal to the square of the number of users.
Mm-hmm.
I think that actually understates it, because it's not only the square of the number of users, but it's also the value they get through that use. How much of their time is spent on it, how much value they derive. And I felt the internet would eventually cannibalize every other product and service. So starting with that basic belief, and you looked at how the internet was distributed at that time, it was mostly dial-up modems. It was a little bit of cable modem. We were at DOCSIS 1.0, no fiber, no internet over mobile, and some DSL. At that point, it was clear that users wanted this flexible network, and two, applications were being developed that would end up breaking the underlying networks. So the idea was to take the architecture that was developed within the enterprise for local area networking and build it on a global scale. So it's building a LAN architecture globally, IP over DWDM, protected at layer 3, using Ethernet as the interface.
Now, let me interrupt you really quickly because I want to make this content a little more approachable. And, you know, the way I would describe what you just said is IP over DWDM, and correct me if I'm wrong here, but I read a white paper by Cisco from the early 2000s that had a paragraph that basically said IP or DWDM technology theoretically offers unlimited capacity. So maybe that's pretty earth-shattering for any business, that a technology could offer unlimited capacity. What is that? What do you, I guess, like when you looked at the technology set, and obviously you've ridden down those cost curves over time and benefited from that, but maybe dumb it down for us and describe what that means in practical terms for the business.
Yeah, well, first of all, it means there's little or no scarcity value.
Right.
2, you need to be able to capture the advances in technology more effectively than your competitors. You know, in a perfectly competitive market, marginal costs go to marginal revenue, and there are no economic profits. You make profits either through the migration to that equilibrium or through an imperfection in the market. You want to capture that imperfection. And that's really interjected by the rapid rate of technological change. So Cogent was built with basically 6 fundamental pillars. The internet be the only network that mattered. Bandwidth's a commodity. You have to be the low-cost producer. Marginal cost is always below average cost, so you had to get scale quickly. Your largest single cost is subscriber acquisition, so you had to have a very compelling value proposition to lower that subscriber acquisition cost. You needed to be able to capture that technology, and local access is a monopoly. And as such, you had to be very thoughtful about where you overbuilt. So by the late 90s, it was possible to buy dark fiber, not build it. There's surplus that were built by others.
Yep.
People thought I was crazy when I went out and said, I don't want to buy a whole bundle. I just want one fiber. And what they did not understand fully is how rapidly the rate of improvement in IP and DWDM technology would make that fiber virtually unlimited. So today,
Right.
for example, Cogent operates one pair of fibers. We're only using a few percent of the theoretical capacity of that fiber, yet we carry 24% of the whole internet.
Right.
So the technology has advanced much faster than even computer technology. So optical transport for 35 years, since the first async 565 systems were deployed, has fallen at a compounded rate of 80% per year. Moore's law is only 55% a year.
Right.
And we are much further away from the physical material science constraints that chip manufacturers face. Optical routing has fallen at about 40% per year for about 30 years. And that's more a reflection of a orderly duopoly than it is the real rate of underlying technology improvement. But the problem is, if you're running a telephone or a cable network, you can't capture all of that advantage based on supporting those legacy services concurrently with the internet. What Cogent did was started with a clean slate. It literally had a corporate network. The equipment had matured to the point where it was just as reliable as telco equipment. You could build it on a very large scale, and it was so much cheaper. And you could then purpose it solely for the internet. You could connect only to the highest traffic locations. And then you offered an unbelievable deal to the customers that then magnified the effectiveness of your sales force.
Right.
And there were 1,400 competitive carriers that were institutionally funded in the late 90s, and an additional 200 backbones. Today, out of those 1,600 companies, less than 5 of us exist. And it's because they all tried to move up the value chain and sell intelligence, as opposed to kind of understanding that we're plumbers and we sell pipe. We don't.
I mean, Cogent's motto is smart people buy dumb pipes, right? So I want to ask about that, because when you started Cogent, I know you talked about raising, I think, 500 million of capital. I don't know how much of it was equity capital. And you had an original vision of what it would take to build this business and get to the scale that you needed to make this a good business. But I want to take a step back from the investor's perspective and talk about, I think you guys are the only telecom company, wireline telecom company, that is sitting at peak organic revenues today. Everyone else around you has been in secular decline for decades. And so you've been a nice house in a horrible neighborhood. And I wonder, for you and your kind of journey as a business person, has it delivered the economic outcome that you expected? Has it evolved in the way that you expected from an industry's perspective? Has Cogent evolved and grown and taken market share in ways that you envisioned when you started the company in '99? Or were there things that developed faster or slower than you expected, given what you were able to assemble through your M&A strategy in the early 2000s?
So it turned out to be a lot harder than I expected. My last company, it was easy. You deployed a network and you got paid 4.5 times the capital you spent, independent of whether it even had revenue on it. People were buying physical assets at a multiple of PP&E. I really thought when I founded Cogent that we would operate for a couple of years and a bigger company would take us out. We were lucky enough to raise $500 million of seed capital. We were lucky a second time in that we didn't spend most of that money. Now, we had originally anticipated the $2 billion budget to build the business. We had spent 45 of the 500, and it was obvious the world had changed. At that time, we sat down with the investor base and we either laid out the strategy to shut down and dividend out the cash. We had 10 private equity and VC investors. Second option would be those guys could write the next $1.5 billion check. And I can assure you that was a very short conversation. And then the third option was to take our pool of capital, treat it as a blind pool, and buy distressed assets. We chose that strategy. I had never done distressed purchases of companies before. It was a great learning experience, and we looked at 121 targets. We bid on 19. We were successful in buying 13 companies, 6 public, 7 private. They had raised $60 billion, the 6 public at peak had a market cap of $61 billion. They had raised $14 billion of capital, $4 billion of PP&E. We paid $60 million, required $150 million of cash, $400 million of acquired preferences, $500 million of debt required. We then fired the customers, fired the employees, crammed down the debt and the preferences, dismantled the networks, and then built Cogent out of those piece parts. So we got here in a very different way than I anticipated, but where we ended up is exactly where we expected to be.
So you got there much more cost efficiently.
with
But
500 million versus 2 billion. So
right,
it's
right.
worth as much. And we probably had a bigger network than we had originally contemplated.
Did you think when you started Cogent, when you were buying these distressed companies and repurposing them, did you think that you would accumulate market share faster than you actually did in the early years after you'd integrated and repurposed them?
Yeah, I think we offered services at a 50% discount to the market on the wholesale side, and on the retail side, 30 to 60 times more for the same price.
Right, right.
We thought the sales pitch would be easier.
Mhm.
What we didn't fully understand is consumer inertia. They've got something, it's good enough, even though you've got a better solution, if it's not broken, they're not going to focus on it. And kind of breaking through that inertia is probably the hardest part of our model. You know, we're unique in that we're 99% of revenues derived from direct sales. Most telecom companies use agents and influencers. So it surfaces an expensive sales technique, no advertising, 550 people sitting in cubes making 100 cold calls a day. But it turns out that even with that expensive outreach program, our total expenditure on revenue acquisition is about 1/6 of the industry, and it's value that differentiates us. So it's been hard, but it has worked. And, most businesses don't fully give credit to the sales organization. Thomas Watson Jr. at IBM said it right. He said, nothing happens till a salesman makes it happen.
Yeah.
And you have the best network, the best capital structure, but if you can't sell, you've got a science project, not a business.
Right, right. Is there, using the taxi business from the early days and your experience there, you're at 24% of global internet traffic. I think on subscribe or penetration in your multi-tenant office buildings, you're in the high teens on a per tenant basis. So you have lots of room that you can continue to grow market share. But are there other ways, once you achieve a certain size and scale, to start getting into other adjacencies like P&C insurance in the taxi business, or like communications? Like, are there other things, other angles you can pursue once you have enough market share in these markets that you're operating in?
So, one, we've been fortunate. We've had access to capital, but we've been unfortunate, and we operate in that bad neighborhood that you
Right.
described. And it is not bad, it's blighted, it's distressed. And we have looked at over 825 acquisition targets and passed because we just couldn't be comfortable we generate a return on capital greater than our cost of capital. I mean, this is not a high bar. It's kind of like you've got all the capital in the world available to you, but you got nowhere to deploy it. So
Right.
we bought back stock, we issued a dividend. But, we have had opportunities. Recently, we announced our first deal in 17 years, acquiring the Sprint Global Markets business. If you had asked me 20 years ago if this startup Cogent would buy Sprint, I would have thought you were drunk or stupid or something. It was, a company that was under agreement to be sold to MCI for $129 billion, at $40 billion in revenue, $16 billion of EBITDA, 70,000 employees, and the first fiber optic nationwide network. That business had been ignored for 20 years, gone through a couple of different ownership changes, and was now in the hands of T-Mobile that viewed it as non-strategic. We were able to craft a deal where we're being paid by T-Mobile to take the problem off their hands, but it's really a repurposing story and allowing us to enter an adjacent market, which is selling optical transport services. were what's colloquially known as wavelengths. And, it's not exactly Cogent's business, but it's very closely allied. And, with a negative cost basis in the asset, we have an unfair competitive advantage. I mean, part of capitalism is always trying to figure out how to get an unfair advantage on the other guy.
Right. You've had, I think, unfair advantages from lower basis than your competitors and future proofs network the entire time of through Cogent's existence. But I think you've spoken recently at conferences about your belief that you think you can grab market share in these new revenue stream areas faster than you have in IP transit or in the corporate business. And I'd love to know just why you think that and what evidence and the market that you see that that's possible for you guys.
So the Sprint asset had $20 billion of invested capital, 14 billion, actually 14.5 billion of PP&E just in that one asset. And it's basically sat empty for 20 years. Think of it as an office building that no tenants moved into, and you got to repurpose it now. In our case, we looked at this network, said it's suitable for optical transmission, but there's some things we need to do. First, we need to connect it to the rest of the world. It only connects to itself. It sits as an island. Two, the endpoints are actually suitable for data center space, but they're today full of 20-year-old telco gear that has to be cleaned out, and you need to repurpose these facilities. And we have a sales force that already calls on the buyers of these optical transport services. We have credibility, and the market is fairly concentrated with a handful of players, and the customers are not happy with those players. We also have some discrete advantages. The routes are physically unique. They're along railroad right-of-way that was built, back in the 80s. The fiber turned out to be better than the fiber deployed in the 90s for newer technologies. We also have more data centers connected than anyone else in the world. So as soon as we can connect that network to our network, we immediately get this expanded addressable market. And we package those kind of advantages together, coupled with the fact we're being paid $700 million to unwind this business for T-Mobile. It seemed like a great opportunity for Cogent. We'll keep looking, but one thing we've been is disciplined. We've watched lots of companies roll up lots of assets only to end up overpaying and having to live with those sins. I think, to me, you can make many mistakes in business, and I'm sure I've made them, but the cardinal sin that you can almost never recover from is overpaying for an asset.
Right. I think what you guys have and what you have done over your career clearly is you've been a disciplined capital allocator and operator and investor in all these different end markets. And it's left you, that's why you're able to just let the neighborhood deteriorate around you, and you basically buy your neighbors on foreclosure, right?
Although I actually wish the neighborhood around me would get better, because it would make our job easier.
Yeah.
That's not happening. The internet
Right.
is deflationary.
The nature of the telecom business is deflationary, and is it has characteristics that make it a difficult neighborhood until you reach some kind of maturity on the services side, the revenue side, the network, physical networks need to be at kind of what Cogent looks like today everywhere. And the revenues need to be deflated all the way to, commodity-like levels over time. And we're just not there yet. But in the meantime, why would you overpay for revenues that would deteriorate and deflate over time among your peers? On the Sprint deal, how do you frame as an investor or capital allocator in this business obviously you're getting paid $700 million to take it off their hands. It's money losing today. How do you think about kind of the upside case of that, and more importantly, I'd say the downside case of buying that business, taking it on? I think it's been pretty controversial among investors because if it's such a problem for T-Mobile, why won't it be a problem for Cogent? How do you diligence those assets? How do you diligence a company like that ahead of making that deal? And how do you assess kind of the risk and reward of making such a deal?
Yeah, so first of all, the network exists. It was built for long distance. It's been in a single owner's hands. You can get the route maps, the engineering data. You could go physically tour the endpoints, so you can touch and feel what you are buying.
Mhm.
And you're really getting three things. You're buying the physical network, you're buying the real estate at the ends, and you're getting a broken operating business of large enterprise customers buying a smorgasbord of products that are unprofitable. You can address each one of those areas independently. So on the customer base, we required T-Mobile to end of life a lot of gross margin products, to shrink the customer base. And what we're left with is a base that can be stable and then grow. Secondly, but in and of itself, that's not a great business. It's burning cash with a lot of work, subsidies from T-Mobile. It can become cash flow positive, but it's a lot of work for very little gain.
Mhm.
Second thing is you've got just 1.6 million square feet of technical buildings that they built and own all around the country that are basically empty. And there's demand for data center space. You need to clear the telco equipment out. You need to connect it to the rest of the internet. You need to modify the power systems, and then you can sell space. But the real asset here is that fiber optic network. It's 19,000 route miles of fiber connecting every major city pair, and then another 1,100 route miles of metropolitan fiber within cities. And a network that today has anywhere from 24 to 144 strands along every stretch of right of way. And you say, what do I do with this network? Well, first, I don't sell long distance voice. There's no demand for that. I don't need it for the internet because I have enough. I can put some of my traffic on it, but that won't consume that capacity. But there is this adjacent market that exists for people that have data that need either additional security or do very large file transfers outside of the public internet, usually to connect large data centers to one another.
The cloud hyperscaler.
Hyperscaler to hyperscaler facility.
Right.
And there's a real market there and a real industrial need. And today they're stuck with basically Lumen and Zayo as the two suppliers, and they're along the same right of way and plastic conduit with fiber that was built in the 90s that's suboptimal and somewhat dysfunctional companies. So we come to market with a better product, a better price point, a better set of endpoints, and just kind of common sense customer care 101. You actually provision what you sell, you do it relatively quickly, you do it at a reasonable price. And I feel pretty comfortable that there's always risk, but we have a sales force that already talks to these buyers. We've interviewed them pre-closing, even pre-signing. We've been able to sell some services before we close. And I think there's just not a lot of risk here.
Yeah, yeah. What do you think, or in terms of looking at the history of your M&A, where do you think this could rank in terms of the, I guess, the deviation from the standalone path versus, other acquisitions you've done?
So we're getting paid the most,
Yeah.
asset cost the most to build.
Hmm.
We're taking on an operating business, which we never really did before. We shut down those businesses. And an important reason why T-Mobile is paying us is they don't want us to harm that customer base, and we're committed to that. So we have to fix it. Now, it's things we've done before, bringing traffic off net to on net, grooming locations, tightening up the network, right-sizing the employee base. There's a number of things that we've done, but here we got to do it and keep an operating business. Now, we don't think it's going to be a great business. It's not going to be a growth business, but it'll be a viable business. And then
it's really all in the repurposing. All of the reason you're doing this is 100% around the repurposing of the assets.
Absolutely.
Pretty similar to what you did 20 years ago, repurposing all of those other businesses, correct?
Yeah, PSINet did not have the Cogent business model. Advisor did not have the Cogent business model. Carrier One didn't, LambdaNet, FirstMark, networks that we bought around the world, but we were able to take the assets and the capital they deployed and architect them in a rational way to build a viable business. They didn't have a viable business.
I know we're coming up on time, so I want to just finish with one question. What do you think creates equity value long term in this business? Or in any business?
In any business, in any industry, the operators of the business have to answer three very simple questions. And I'm always shocked that public management teams don't think in these terms. Do people need what I'm selling? Why will they buy from me versus the other guy? And then if they buy from me, how do I make money? Those are three questions, whether you're a car manufacturer, an internet provider, a restaurant operator, or a clothing store. Every business has that common set of questions. And the way we create value here is, quite honestly, while we're in a bad neighborhood, we're lucky. We don't have to create demand. I don't have to take out ads on the Super Bowl to convince people to drink brown sugar water and tell them it's good for them. But everybody needs the internet. So everybody needs what we have. We don't create demand. All of those applications create demand. When I was a little kid, they used to have time and weather you could call on your phone for free. And the phone company offered that as a service to get people to use phones more. Well, here I've got literally millions of entrepreneurs around the world trying out new business models, most of which are stupid and will fail, but they're generating traffic demand. So there's plenty of demand. In terms of the second question, why will they buy from us? Because we deliver more value. It's that simple. It's not because our salespeople are smarter, look better, or, have a fancier business card. It comes down to customers making a rational business decision based on value. And then the operating leverage we've established shows that we can take that revenue and convert it into meaningful cash flow. That's how we build value. And we'll continue to look at assets. I don't think we're doing another deal. There's nothing else in the hopper. Yeah. But in that bad neighborhood, if things come along, we'll look at them. If they're not accretive, we walk away from them. And, you can't ever fall in love with your business. You can be passionate about it, but you can't be emotionally attached to it. It is a vehicle to create value for its stakeholders. And as long as your capital structure is more equity than debt, your stakeholders are your equity.
Mm-hmm. I guess that leads me to one last question. I apologize, but I'm curious. You've started 7 companies, I believe. this is by far I think the longest you've spent at any of those companies. Why
Couple
is
of
this
years. Yep, I was in the campus at 17. I've been here 23.
right? Why is this the one that has kept your time and attention?
Well,
for
the
all
others did. It's well, first of all, I hated the campus. So I'll be first. I hated
You like the
it.
cash flow, hated the business, sounds like.
I loved the money, but I didn't like the business. Never did. Um, this is relatively enjoyable, but there's a lot to do here. There's value to be created. There are opportunities. And, listen, the purpose of a business is to create value for its stakeholders. It's a little broader than just profits for shareholders. I don't necessarily buy the Milton Friedman 71 New York Times editorial. I do believe in the business roundtables, broader view of employees and consumers and society. But there's still an objective report card, and it's called profits, and we're doing that. And that's satisfying.
Yeah. Well, I think, you guys play a very critical role in the global, the modern economy, right? You're 24% of global internet traffic. You provide best value connectivity into multi-tenant office buildings. Increasingly, after you close this deal, presumably you will be a critical component of the fiber fabric that connects the cloud hyperscalers together. And in the research that I've done in that area, there seems to be an insatiable demand for point-to-point optical wavelength transmissions, and especially route diversity, which presumably that asset base will bring. So there's a lot of share to gain, I guess. And I assume because you're such a rational economic actor, that if you didn't think there was a lot of value to be created here, you wouldn't work as hard as you do at Cogent.
Go do something else.
Yeah, you'd be going to do something else, exactly. So, well, let's call it there, Dave. I really appreciate the time. This has been a lot of fun, very informative. I learned a lot. I know you and I mostly talk about the core business and things that are more incremental. It's really nice to fill in the backstory and learn more about your journey to this point. So I really appreciate it. It's been a great conversation for me.